Welcome to another deep dive into the world of financial markets.
All right.
Specifically, trading and analysis.
Cool.
And we've got a pretty fascinating mix of sources this time around.
Cool.
We've got excerpts from some academic textbooks on quantitative finance.
Nice.
And we've also got some practical guides that are actually used by traders.
Great.
And then we even have some technical manuals that break down trading software.
Sounds like a lot.
Yeah. So the mission here is to give you a solid grasp of how to develop trading systems, how to manage risk, and also we're going to equip you with some analytical tools to decode market behavior and trading strategies.
That sounds great.
Yeah. I think we're going to uncover some really interesting stuff.
Yeah. What did we learn today?
So, for example,
Okay.
we're going to uncover this concept of an option to default
Okay.
that kind of lurks within over-the-counter derivatives.
Okay.
Which is something...
So OTC derivatives?
Yeah.
Okay.
A lot of seasoned traders may not even
Really
be aware of.
Wow.
So we're really going to go kind of deep here.
Nice. So we're not just going to scratch the surface.
No, not at all.
Cool. So what else can we look forward to?
So we're also going to be getting into
Yeah.
how to create and evaluate trading systems.
Nice.
And that's going to involve concepts like walk-forward analysis
Okay.
and this like ever-present danger of overfitting.
Yeah, everyone overfits.
Right. And then we're not going to just stop at the technical side.
Oh, okay.
We're also going to explore this often overlooked but incredibly important part, which is the psychology of trading.
The psychology, yeah, that makes sense.
Yeah, so we're really going to give you a comprehensive toolkit, I think,
Awesome.
to navigate the markets.
All right, let's do it.
So let's dive right in.
Yeah, where should we start?
So I think first we need to demystify over-the-counter derivatives.
Oh, definitely.
These are often just called OTC derivatives, and unlike traditional exchange-traded derivatives, OTC derivatives are contracts that are negotiated and traded directly between two parties without the involvement of an exchange.
Gotcha. So it's like a private deal
between
institutions.
Yeah, exactly.
Or individuals even.
Individuals, institutions.
Well,
yeah.
okay.
Yeah. Now, this direct negotiation does offer flexibility, but it also introduces this unique risk.
Okay.
It's known as counterparty risk.
Counterparty risk.
Yeah, and that's basically the risk that the other party in the contract might fail to fulfill their obligations.
Okay.
Maybe because of bankruptcy.
Okay.
Or some other unforeseen circumstances.
Wow, so that's kind of like lending money to a friend?
It's like...
hoping they pay you back.
Yeah.
But with much higher stakes.
Exactly.
Yeah.
And so this is where the concept of the option to default comes in.
The option to default.
Yeah.
What's that?
And this is highlighted in our source, 2007 Quantitative Analysis.
Right.
And it's not like an explicit option written into the contract. Yeah. It's more of an implicit, right? That both parties hold.
So are you saying that even the party who's supposed to receive a payment, they could choose not to pay?
Exactly.
Wow, okay.
It's a two-way street.
So it's both sides have this option.
Yeah. Even if it's not something that they would typically exercise, this kind of hidden aspect of OTC derivatives, this is what makes understanding and managing counterparty risk.
Makes sense.
Absolutely crucial.
Okay, so how do traders navigate this minefield? Of counterparty risk?
Fortunately, there are several strategies for mitigating this risk. Our sources point to the use of structured notes.
Structured notes.
Yeah, and credit extinguishers as effective tools.
All right, so what is a structured note?
So think of a structured note as like a hybrid investment.
Okay.
It blends characteristics of a bond and a derivative. It offers a return that's linked to an underlying asset's performance, but with added credit protection features.
So it's like built-in insurance.
It's like built-in insurance.
Okay.
Against those potential defaults.
That's interesting.
Yeah. And
okay, what about credit extinguishers?
Credit extinguishers are another really interesting tool.
Okay.
These are basically derivative contracts that are designed to terminate. If a specific credit event occurs.
Right.
Like, for example, the counterparty defaults.
Oh, so it's like a safety switch.
It's like a safety switch.
That just shuts things off.
Yeah.
If it goes bad.
Shuts off the deal if things go south.
Okay, that's pretty sophisticated.
Yeah, and it shows you how sophisticated this world of derivatives has become in addressing very specific types of risks.
Okay, so we've talked about the risks of OTC derivatives.
Right.
Are we ready to move on to building our own?
I'm kind of eager to move on to like learning how to build our own trading systems.
Trading systems.
We've got two really technical sources here to guide us.
Right.
The first one is called Developing Predictive Model-Based Trading Systems.
Okay.
Based TSSB.
Right.
And then the other one is called Statistically Sound Machine Learning for Algorithmic Trading of Financial Instruments.
Ah, those are mouthfuls. Where do we even begin with this?
Right. So it all starts with data, specifically historical market data.
Okay.
This is really the foundation upon which you will train and test your trading system.
Right.
But it's not as simple as just downloading a mountain of numbers.
You can't just plug it in and have the magic happen.
No magic here.
Right.
The process of curating and processing the data is crucial.
Okay.
And our sources call this read market histories.
Read market histories.
Yeah.
That sounds like something out of a programmer's manual.
It's like practically is.
Okay.
It is. So what is it? So this command within a trading software environment basically tells the system where to locate the historical data files.
Okay, so it's like giving it a map.
Yeah, you're giving it a map.
To find the treasure.
To the treasure trove of market data.
Okay.
And another crucial command is read variable list.
Read variable list, okay.
And this is where you define the specific indicators and variables that you're going to use.
So you're picking what you're going to look at.
You're choosing your lens through which you're going to view the market, the market's movements.
So this is where things start to get technical.
This is where it starts to get technical.
Okay.
This is where the magic of feature engineering comes in.
Feature engineering.
You need to transform that raw market data into meaningful indicators that can potentially reveal patterns and predict future price movements.
Okay.
So one example from our sources is the delta on balance volume indicator.
Delta on balance volume.
Yeah, and this analyzes how the volume of trades correlates with price changes.
So it's not just how much the price moves.
Right.
It's also how strong.
Right. It's the force behind that move.
Gotcha.
As reflected in the volume.
Okay.
So for example, if you see a surge in volume that accompanies a rising price that could signal strong bullish sentiment.
Gotcha.
And vice versa.
That's really cool.
Yeah, and so there's all these seemingly simple data points like price and volume that can be combined to create these insightful indicators.
Nice.
So are there other
types of indicators?
Other indicators we should be aware of?
That we could be aware of. Oh, yeah, absolutely.
Like what?
There's a whole universe of indicators. You've got everything from moving averages to wavelets. Each designed to capture different aspects of market behavior. It's like having a toolkit filled with all these specialized instruments. Each revealing a unique aspect of the market's intricate machinery.
So once we
gather our data and choose our indicators.
So once we've gathered our data, chosen our indicators, how do we actually take all this and translate it into trading rules?
Trading rules,
This is where the creative process of system development comes in. You can use simple rules, like those based on moving average crossovers, or you can delve into much more complex strategies using machine learning algorithms. And the beauty is you can actually test these rules using code snippets. Like the ones provided.
Let's go in here.
In our source material.
Awesome.
Yeah, so our listener can actually try this out themselves.
Nice.
They can start experimenting and building their own systems.
Cool.
So now we've got our data. We've got our indicators. We've got our trading rules all coded up. What's the next step?
So then what?
In this trading system development process, the next crucial step is backtesting.
Backtesting.
This involves running your trading system on historical data to see how it would have performed in the past.
So you're basically taking it for a...
Yeah, it's like a test drive.
A test drive.
Yeah.
Okay.
Before you put real money on the line.
Right. But how do we know if that's...
a reliable result?
If our backtesting results are reliable, what if we just got lucky?
Right. What if it was just a lucky set of data?
With a particular set of data.
Okay.
That's a great question.
What's that?
And it brings us to the critical concepts of walk-forward analysis and avoiding overfitting.
Walk-forward analysis.
That's what we're going to
delve into next.
Cool.
Yeah.
Can't wait. I'm ready to hear about that.
Okay.
How to avoid those pitfalls. Walk-forward analysis is kind of like giving your trading system a series of pop quizzes.
Pop quizzes for a trading system.
Yeah, to assess its performance over different periods.
Okay, that's a mental image I wasn't expecting.
It's a helpful way to visualize it.
Okay.
Imagine dividing your historical data into segments.
Okay.
The first segment is used to train your system.
So that's like the systems study session.
That's a good way to put it.
Okay.
This is where you find the optimal parameter.
Okay.
You tweak the rules.
Okay.
You refine your strategy.
Okay.
And then you test that train system on the next segment of data.
So this is the pop quiz.
Yeah.
All right.
And crucially, this data represents a period that the system has never encountered before.
So it's truly a test of whether it can apply its knowledge to a new
situation.
Exactly.
Yeah.
And you repeat this process.
Okay.
Moving the training and testing windows forward in time.
Okay.
This way you get a more comprehensive evaluation of how the system performs
across
various market conditions. This walk-forward approach.
Yeah, it seems a lot more...
It is.
Much more robust.
A single back test.
Yes.
Okay.
It helps you avoid the trap of overfitting.
Yeah.
Which is essentially when your system becomes too tailored to the specific nuances of the historical data it was trained on.
So it's like that student memorizes all the answers for one specific test, but then can't generalize the knowledge to new problems.
Perfect analogy.
Okay.
Developing predictive model-based trading systems. Based TSSB. Offers excellent diagrams that visually illustrate the difference between walk-forward testing and a similar technique called cross-validation.
Cross-validation?
Yeah.
I'm curious how that...
So cross-validation also involves dividing the data into segments.
Yeah.
But it uses a slightly different method. Imagine creating multiple folds or subsets of your data and using different combinations of these folds for training and testing.
So it's like shuffling a deck of cards, dealing out different hands for each round of training and testing.
Yeah, it's a statistically intensive method, often used in machine learning to ensure that your model can generalize to unseen data. So both walk-forward analysis.
Yeah, they both seem really valuable.
They are.
In this fight against overfitting.
Exactly.
But are there any other ways to assess if our system is truly robust?
Well, how do we know
ready?
If it's really ready?
For the real world.
For the real world, right?
Yeah.
There's another key concept called walk-forward efficiency.
Walk-forward efficiency.
Yeah. It's a metric that compares the performance of your system during the training phase to its performance during the out-of-sample walk-forward testing.
So if the walk-forward efficiency is high, it means the system performs almost as well.
Almost as well.
On new data as it did during training.
Exactly. A high walk-forward efficiency indicates that the system isn't just memorizing
past patterns, but can actually adapt.
So it's a measure of how well it can generalize its knowledge.
It is to the real world.
Real world.
Exactly. But our source, the evaluation and optimization of trading strategies, suggests that overfitting is a tricky beast with many disguises.
So what are some
other forms
of the other forms that it can take?
It can take, right?
Yeah.
Overfitting can manifest in different ways. Like over-optimization, curve fitting, and data mining. Over-optimization is when you become obsessed with squeezing every last drop of profit out of the back test, tweaking parameters until you achieve stellar results.
But this often leads to a system that's highly
very specific
to that historical data. and performs poorly.
So it's like a custom-tailored suit
Yeah.
that fits perfectly in the fitting room.
Yeah.
But then when you try and wear it out
Yeah.
in the real world,
Right.
it just falls apart.
Exactly. Per-fitting
Okay.
is another form of overfitting.
Okay.
Where you essentially
Okay.
create a system
Yeah.
that perfectly matches past price movement.
So it's like you're drawing a line that connects all the dots on a historical chart.
Exactly.
But it has no relevance.
But no predictive power.
Where
the next dot might appear.
Mm-hmm. Price action.
Yeah. Okay.
And then there's data mining.
Data mining of it.
Which is like going on a fishing expedition.
Yeah.
Through
mountains of data.
Mountains of data.
Looking for any pattern.
Searching for any pattern.
That supports your preconceived notion. Your trading idea.
Your trading idea.
Exactly.
Okay.
So even if we find something.
Yeah. It might just be a random fluke.
A product of chance.
Yeah.
Rather than a genuine pattern.
Okay.
Our source emphasizes the importance of rigorous testing.
Yeah.
And a healthy dose of skepticism.
Okay.
You need to make sure that any patterns you discover are statistically robust.
Okay.
And not just the result.
Right. Not just random noise.
Of random noise.
Yeah. And I think this really highlights the need for critical thinking and objectivity.
Right. When we're evaluating
your trading systems.
Trading systems, we can't.
You can't
let
your desire for profits
blind us.
Blind you.
To potential flaws.
To flaws in the analysis.
In our analysis.
Exactly.
Right.
And this is where the concept of hindsight bias comes into play.
Hindsight bias. It sounds like
a dangerous trap.
A dangerous trap.
Well, traders.
For traders, right?
Yeah.
Hindsight bias.
Okay.
Is the tendency to look back at past events.
Yeah.
And think they were more predictable than they actually were.
So it's like watching a movie for the second time and thinking, oh, I totally saw that coming.
I knew it.
Yeah. But in reality, the first time you watched it, you were probably...
You had no idea?
Completely surprised.
Yeah, I'm definitely guilty of that.
Yeah, me too. But how does this hindsight bias relate to
trading
and overfitting?
Right.
So in trading, hindsight bias can make you believe
can make you think
that certain trades were obvious, winners or losers.
Right.
But in reality,
there was a lot of uncertainty
at the time.
Yeah. The trades were placed. So it's like looking back at a winning trade and saying, oh, of course, that was a good decision.
It was so obvious.
Right. But forgetting. That at the time, there was a real risk.
That it could have
gone the other way. Right.
Mm-hmm. Yeah.
So hindsight bias.
Hindsight bias distorts your perception
of past events, making us overconfident.
Making you overconfident.
In our ability to
predict the future.
Okay,
so how do you guard against this insidious
hindsight bias
and avoid overfitting our systems? One key strategy.
One key is to focus on the process. Not just the outcome. Of the trade. Instead of dwelling on what you should have done.
Yeah.
Ask yourself. If your trading decisions were logical. And consistent. With your system.
At the time? So it's like focusing.
Focusing.
Playing the game well.
On playing the game well.
Yeah.
Rather than
just obsessing over
the score. Exactly.
Okay.
Another important strategy is to ensure that you have
a
statistically significant sample size of trades. You wouldn't judge a basketball player.
Based on
a single free throw.
A single free throw, right?
Right.
You need to see them.
Play.
Over multiple games?
Yeah, multiple games.
To get a true sense.
of their skill. And in trading.
Yeah.
A small sample size.
Small sample size can be very misleading.
Okay. Our source suggests a minimum of 30 to 50 trades.
For
a robust evaluation.
Yeah. Okay, so we need to
You need to
back test our
test over a long enough period.
Right. To get a decent sample size.
To get a good sample size.
And we need to be mindful.
And you need to be mindful.
Of hindsight bias.
And other forms of overfitting.
Alrighty. Yeah, but even with the most rigorously tested system.
There's another crucial element.
We need to consider.
You need to consider.
Which is the human element.
You're absolutely right.
Okay.
And that brings us to
the fascinating realm.
I'm excited to delve into this.
Of trading psychology.
We've got two great sources to guide us here.
Okay.
Enhancing trader performance.
All right. And super trader. And both of these sources emphasize that successful trading is not just about numbers and systems.
About numbers.
Yeah.
It's more than that.
Yeah.
It requires
a deep understanding of your own psychology.
And
how that interacts.
And how it interacts with the
market. So it's not enough.
It's not enough to just
have a winning system. You
also
actually need
to have the
right mindset.
Right mindset to execute that system.
To execute it.
Effectively.
Okay. Super Trader puts it beautifully. It says systems. Like pants.
Should fit you. Right.
I love that analogy.
It's a powerful reminder.
Yeah. It's so simple.
Yeah.
But so profound.
Right.
Your trading system.
A trading system should align
with your
personal beliefs, objectives,
risk tolerance.
Right. It's not about finding some
It's not about
one size fits all.
Holy Grail system.
One size fits all.
Right.
Holy Grail system.
That works for everyone.
Right.
It's about banning the system.
Finding a system
works for you
that is compatible with
your own personality.
Right. And your trading style.
And
enhancing trader performance.
Yeah.
Introduces
this concept of market personality. The idea that markets
people have their own
unique characteristics and behaviors.
Have personalities.
Yeah.
Right?
So some markets might be.
Yeah, some might.
More volatile and unpredictable.
While
others more stable.
And trend following.
And
so
just like in human relationship. Compatibility is key. You need to find markets
and trading styles that align with your personality
and your risk appetite. If you're someone who thrives on fast-paced action and taking risks, you're probably going to be miserable. Trading some long-term buy and hold strategy.
Right.
In a slow-moving market. Yeah.
The key is
to
know yourself.
And find a trading approach. That you're comfortable with. Even when the market throws you curveballs. Because inevitably it will. Right. Trading is a roller coaster.
Filled with
ups and downs. Even the best systems. Experience periods.
Emphasizes the importance of managing your emotions.
Right.
Especially during those challenging times.
So
it's not about trying to
eliminate emotions altogether.
Eliminating your emotions.
It's about
being aware
of
our emotional patterns.
And
developing strategies.
For staying disciplined.
Even
when
fear
or greed
start to creep in.
Emotions are an integral part.
You can't just shut them off.
Yeah. We can't just shut them off.
But you can learn. To manage them.
Effectively.
And both of our sources.
Right. And both of our sources.
Offer some great practical advice on this. Okay, they talk about
setting realistic expectations. Creating a trading plan. And sticking to it. And even taking breaks. Yeah.
When you need to. Clear your head. And regain perspective.
All those are crucial elements.
They're crucial.
Of successful trading.
Super Trader
reminds us
that you can trade.
Only your beliefs.
About the market.
About the market. So understanding your own
biases
and
beliefs
is vital.
Is a vital step
towards developing
a
trading approach that is both profitable and psychologically sustainable. This has been a really eye-opening discussion
about the psychology of trading. But even with a right mindset
and a well-defined trading system, we can't forget
about
the importance of risk management. After all,
because even the most psychologically balanced trader can experience significant losses if they don't manage risk
effectively.
You're absolutely right.
Risk management
is a fundamental pillar of successful trading. And our source, trading a trader's money, is a fantastic resource on this topic. It provides actionable strategies for protecting trading capital and minimizing potential losses. What are some of the key takeaways
from this source? On risk management,
right?
Yeah.
The most crucial concept is the use of stop-loss orders.
Okay.
These are orders that automatically sell your position if the price drops to a certain level.
So they limit your potential losses.
Limiting your potential losses.
In a trade.
On a trade.
Stop-loss orders sound like...
They are an essential safety net.
For traders.
But
I imagine there's an art. To setting them correctly.
Right. You wouldn't want to set them.
You don't want to set them
too tight. And get stopped out. Of winning trade prematurely.
Of winning trades too early.
Right. But you also don't want them.
But you don't want them
to be too loose. And risk incurring those large losses.
Right.
You're exactly right.
It's like
it's about finding
tightrope walk.
That sweet spot.
Trying to find
optimal
balance between risk and reward.
Protecting your capital. And giving your trades room to breathe. Exactly. Our source provides a detailed risk list. That helps you identify the different types of risks you need to consider when setting those stop-loss orders. And this includes factors like market volatility risk, gap risk, and even event risk, like an unexpected news announcement. That can send the market into a tailspin. So it's a comprehensive approach. To risk management. That's really taking into account various potential scenarios that could impact our trade. I can impact your trades.
Right.
And it emphasizes
the
importance of having a personalized plan.
Risk
management plan. That's tailored to you.
That's tailored to
your trading style.
Your
risk tolerance. And the markets you trade.
And the specific markets you trade.
Exactly.
There's no one-size-fits-all. Approach to risk management.
Your risk management. It's about understanding your own risk profile.
Understanding our own risk profile.
And developing a strategy.
That aligns with
your
personal circumstances and goals.
And trading goals.
Now, while we're on this topic of risk, I want to introduce a fascinating concept called intermarket analysis.
Which is highlighted in Marco's intermarket trading strategies.
Intermarket analysis.
Yeah.
That sounds...
It's a powerful tool.
Intriguing.
That helps you.
What exactly?
See the bigger picture.
Does it involve?
It involves analyzing the relationships between different asset classes. To identify potential trading opportunities.
So instead of focusing on one market in isolation, we're looking at how
it interacts
with other markets. Yeah, so how movements in the bond market.
Right, how movement in bonds
might affect stock prices,
or
how the price of gold,
or how gold
could be influenced by
the dollar.
Changes in the U.S. dollar.
Exactly.
So it's about
Connecting the dots.
Connecting the dots.
And seeing patterns that you might miss.
And seeing patterns where you might miss. Just focused on one market.
If you were just focused on one market,
okay,
our source explains various statistical measures used in intermarket trading, such as correlation coefficients, and the Sharpe ratio.
Sharpe ratio. Yeah. Can you refresh our memory on what those
measure? Oh. A correlation coefficient measures how closely two assets move together.
Okay.
A positive correlation means they tend to move in the same direction, while a negative correlation, that means they move in opposite directions.
So if gold and the U.S. dollar have a negative correlation, when the dollar goes up, gold tends to go down.
Exactly.
Okay.
Now, the Sharpe ratio
is
a measure of risk-adjusted returns.
Okay.
It tells you how much return you're getting for each unit of risk.
So a higher Sharpe ratio.
Yeah, a higher Sharpe ratio is generally better.
Generally better, you're getting...
Because it means
more bang for your buck.
You're getting more return for the risk you're taking.
Okay.
And our source provides concrete examples of how these intermarket relationships can create trading opportunities.
Okay, for example.
For example, it shows how the euro has historically had a strong positive correlation with certain European stock indices and a negative correlation with the U.S. dollar.
So you could use
movements in the euro to predict movement.
In
those other markets.
Potentially. Exactly.
Okay.
And for
our more advanced listeners, the source even provides some meta-stock formulas for gold trading strategies that incorporate these intermarket relationships.
It's really amazing how...
It's amazing how understanding the interconnectedness of markets can open up new trading possibilities.
Of markets can open up all these new trading possibilities.
But before we move on, I want to emphasize one crucial point that's woven throughout all of our sources. The dynamic nature. Of markets. Markets are constantly
evolving.
We're constantly evolving. So what works today?
What works today might not work tomorrow.
Our sources.
Including dynamic hedging.
And
long-term secrets to short-term trading.
Really drive this point.
Home.
It's like trying to hit a moving target. The market
is constantly shifting and changing.
Shifting and a challenge.
To stay ahead of the curve.
Making it a challenge to stay ahead.
Okay.
Factors like
volatility,
liquidity, and even regulatory changes.
Can
all impact
the effectiveness of a trading strategy.
Can
you give me an example?
Yeah, can you give me an example?
Sure.
Of how these
dynamic hedging,
market dynamics,
provides a great illustration with the concept of the volatility smile. It's essentially a graph that shows how the implied volatility of options varies depending on their strike price.
Implied volatility, remind me what that is again.
Implied volatility is the market's forecast of how much an asset's price is likely to fluctuate in the future. It's a measure of the market's uncertainty. The volatility smile tells us that.
Yeah, the volatility smile tells us that options
have different strike prices.
With different strike prices.
And have different volatilities.
Implied volatility.
And this is valuable for traders.
Right. And this is valuable
because
it gives them insights.
Yeah, it gives them insights.
Into market sentiment.
Into
the potential future price movement.
Yeah, market sentiment and potential future price movements.
Exactly.
Okay, so it's like a window.
It's like a window into the collective psychology
of market.
Psychology of the market.
Revealing how traders are pricing in future uncertainty.
Long-term secrets to short-term trading provides
another example
of
how market dynamics can impact trading strategies. Okay.
It discusses how traders adjusted their approaches after the removal of the uptick rule.
The uptick rule. Right. Wasn't that a rule that...
It was a rule that restricted short selling.
Short selling.
It required
that
short sales could only be executed on an uptick in the price.
Okay. So when that rule was removed...
Okay. It changed the dynamics of the market.
Okay.
Made it easier.
It made it easier...
for traders...
to short sell.
To short sell.
So traders who relied on strategies.
That benefited from that rule.
Had
to adapt.
Or
risk losing money.
Yeah.
It's a constant challenge.
Yeah, it's a constant challenge.
In trading. Staying ahead of the curve.
And
adapting to these ever-changing
market conditions.
So it seems like...
a never-ending learning process.
It is, and that's what makes it so exciting.
Yeah, that's what makes it exciting.
Now, before we wrap up,
okay,
I want to share practical tips and techniques for traders.
Okay, let's hear it.
Gleaned from all of our sources.
Okay.
One key takeaway.
Okay.
Is the importance of understanding the different order types available to traders. The evaluation and optimization of trading strategies highlights the distinctions between market orders, stop orders, and MIT orders.
Can you break those down for us?
A market order is an order to buy or sell at the best available price immediately.
So it's like, just get me in or out.
It guarantees execution. But not the price.
Regardless of the price.
Now, a stop order is an order to buy or sell. Once the price reaches a specific level.
So it's like setting a trigger point?
It's like setting a trigger.
If the price hits that level, the order
is automatically executed. And an MIT order. Which stands for market if touched. It is a type of order that becomes a market order. Once a specific price is touched.
So it's like a stop order.
Yes, like a stop order.
That becomes a market order.
Into a market order.
Once that price is hit.
Exact. Understanding
the nuances
of these
different order types.
Can
be crucial.
For effective
trade execution. And remember.
Yeah, and it seems like
this is just a glimpse.
Choosing the right order type for a given situation.
Into the vast world of trading and analysis.
Impact.
Our sources are packed. With our trading results.
Even more. Practical tips. Like the risk management rule regarding gamma.
Gamma.
Markets, instruments, people.
Now we're getting into the Greek alphabet.
The Greeks are essential concepts in options trading. Gamma measures the rate of change of an options delta, which is a measure of how much the options price is expected to change for every dollar move in the underlying asset.
Delta, gamma. I'm starting to feel like I need a refresher course.
Go too deep. In options trading.
Into the weeds here.
Yeah.
But it's important at least
all these concepts.
To be aware of these concepts. As you delve further into trading. Our sources provide excellent visual examples that can help.
Bring these concepts to life. Dynamic hedging offers a helpful table. Table 7.3. That illustrates the impact of volatility on option prices. And there are some intriguing figures. Like figure 9.8. From markets, instruments, people. Which depicts skewed markets. And figure 10.5. Which shows how volatility affects the price of an at-the-money option.
I'm definitely going to.
It really is.
Check out those visuals.
It's amazing how much information is packed into these sources.
It's incredible.
And this is just a starting point.
Yeah, it really is just...
There's a whole universe of knowledge out there.
It's a starting point.
For traders who are willing to put in the time and effort.
Yeah, for traders who are willing to put in the time and effort.
That's an inspiring thought.
It is. It seems like this journey of trading and analysis.
It is a lifelong pursuit.
It's
always something new to discover.
Lifelong pursuit.
Pursuit, always something.
The markets are constantly evolving.
New to
So should our understanding of them?
Discover and master.
Well said.
The markets are constantly evolving.
As always.
And so should
we encourage you
our understanding of them
to explore the source material further.
That's a great...
Dive deeper into the topics.
Note to end on.
That piqued your interest.
As always...
And continue your journey...
We encourage you...
of learning and discovery.
To explore the source material further.
In this fascinating world.
Dive deeper into the topic.
Of trading and analysis.
That piqued your interest.
Happy trading?
And continue your journey of learning and discovery in this fascinating world of trading and analysis.